A famous strategist calls Bitcoin bitcon and says it has all the characteristics of a bubble. Paul Krugman on tax reform and Fidelity's Matt Fruin on tech valuations. All today on The Bottom Line from the NASDAQ market site in Times Square. Another record high this week for Bitcoin. Cryptocurrencies in general are going bananas. So what is the real outlook on it? You may well know that a strategist by the name of Richard Bernstein, who's one of the smartest out there, came out with a short comment on Bitcoin. He calls it bitcon, which gives you some sense of what his view is. But he says, first and foremost, that Bitcoin actually satisfies the 5 key criteria for a financial bubble. Specifically, there's lots of liquidity, which allows gambling. There is lots of leverage, which allows people to bet a lot more than they have. This is coming from the futures market. There is democratization of the market. Don't know about you, but I am hearing more and more about Bitcoin from folks I wouldn't expect to be interested in trading things that people don't understand. New issues. Thousands now of cryptocurrencies and initial coin offerings and trading volumes increasing. All of these things together, Richard Bernstein says, show that this is indeed most likely a bubble. The good news for Bitcoin speculators out there is he thinks it will continue because ultimately what causes bubbles to burst is the shutting off of the liquidity, which would be the Fed in this case if they start to tighten too much, be careful, and a running out of greater fools to take it off your hands and drive the price higher. Richard Bernstein thinks there are more fools out there who will rush in, so we should be good for a while yet. But we are very pleased to have with us our own cryptocurrency expert, Sara Silverstein. Sara, you are a true believer.
I'm an enthusiast.
What do you feel when you hear Richard Bernstein call it bitcon?
Well, that feels like it's malicious, and I don't believe that. But it could be a bubble. There's a lot of money going into a space that's brand new and where we don't know what the value is. And I do think that there's more money to come into that space. But I think there's a big difference between, we've heard people compare it to the tulip bubble and to the tech bubble. And those are completely different things. It's nothing like the tulip bubble to me, which was hysteria and madness. But it could be a little bit like the tech bubble in that after the tech bubble burst, it still remained a huge asset class. It's a huge part of our economy and is a big part of our market. And we don't know which cryptocurrency will be the Facebook or the MySpace or the Pets.com or the Amazon, but I do believe that cryptocurrencies will persist and remain an asset class. So like that, I think that it's fair to say that it might be like the tech bubble, but that it's nothing like the tulip bubble.
Tulips are useful for growing tulips. There's still a tulip business. People value them that way. But coming back to it, yes, there's definitely utility here. Bitcoin serves a purpose. It seems to be the leading candidate to be the dollar of cryptocurrencies. But agree with you, there is just simply no way to value it. And every time I hear somebody make some smart-sounding argument about, well, it should be some fraction of gold or GDP, just absurd. Just belly up to the table and roll those dice, because that is what you are doing. But you think, like Richard Bernstein, we are headed higher.
Yes, I do. And like Mike Novogratz, who also says it's a bubble, but he says that there's a lot more money to come into it, and including his fund. He has a huge hedge fund that's cryptocurrency based, and we haven't seen institutional money go into it. We just saw futures. So I think there's a lot more money that's going to go into this space. Just like with tech, we saw a lot of money going in before anybody was making any money. There was no revenue, but there was.
Great. And the good news about no intrinsic value is it literally could go to $1 million, which we've said before, and $1. So we have an exciting future ahead of us. Thank you, Sara.
Thanks. Last week at Business Insider's Ignition Conference, you presented your 14 points on the future of media. And the one that really stuck out to me is that we have reached peak media in the US. How is that? Can you explain that?
Yes, we are nearing peak media. And if you look at the amount of time that Americans spend consuming media, what you will find is that, according to a consulting firm called Activate, it's about 12 hours a day. How do we squeeze all that in? We multitask all the time. You are watching TV or listening to the radio while you're smartphoning and doing work and so forth, so we pile them all in together. But what has driven the growth of that 12 hours over the past 20 years has been the development of the internet. First desktop and then mobile. We're now consuming about 6 hours of digital media today across all of the different platforms. Problem is we're all now online. And there is this hope and dream that things like Alexa and Siri and self-driving cars are going to create all this new media time. Just not true. We're already surrounded by audio. Basically, Alexa is just a remote to help us turn on the radio. The only person whose time can be freed up in a car is the driver, and he or she is already listening to the radio, so it's not like there's a lot more time there. So if you look at the growth, expected growth of media consumption over the next 5 years, it's only something like 18 minutes. So we are hitting peak media, and that obviously has huge implications for the overall media industry. It's why you're seeing the consolidation that you're seeing in TV with Disney and Fox, in internet companies. It's why digital media companies are struggling. We just suddenly have reached a finite amount of time, and until we can actually have stuff ported directly into our brains with a chip, like in the Matrix, we're done. We're nearing peak media. The GOP is still working hard to put through tax reform. What will it mean for the economy, and how is the economy doing anyway? Joined by special guest Paul Krugman, interviewed by Josh Barrow, senior political correspondent at Business Insider.
Paul is a Nobel Prize-winning economist. He's on the faculty at the City University of New York Graduate Center. And of course, he's an opinion columnist for the New York Times. Paul, thanks for joining us.
Great to be on.
So let's talk about this tax bill that seems to be rocketing its way toward enactment in Washington. We got an analysis this week from the Treasury Department, this one-page sheet that claims that Trump's economic policies, including this tax plan, should increase economic growth so much that, in fact, budget deficits will shrink despite the large size of this tax cut. Is this a plausible analysis?
So this is analysis with scare quotes, because the number comes out of thin air. They just made up, they said we're going to increase growth by 0.7 of a percentage point, which doesn't sound like that much.
Each year.
So
yeah.
over 10 years that GDP is going to be 7% larger. They gave no explanation of where that comes from. So they just told the Treasury staff to assume that growth rate and then tell us what it does for the budget deficit. And look, it's first of all, that's about 9 times as big as what the Joint Committee on Taxation, which is Congress's official evaluator, says we're going to get out of these tax bills, and it's just it's a crazy number. No, advanced economies like the United States, at the technological frontier, with not completely crazy economic policies, there's almost nothing the government could do. The most ideal policy in the world is not going to boost GDP by 7%. So this is crazy.
So there's been a variety of different analyses that have come out. You've talked about this joint committee number that found this modest but positive effect on economic growth. Right. There was also an analysis from the Tax Policy Center, which is it's a joint project of 2 sort of left-of-center think tanks in Washington. Their analysis also finds a very modest positive effect on the economy. Do you think this is right? Do you think this tax plan will be growth positive compared to doing nothing at all?
There's 2 questions here. One is, we really are not, none of these studies are very good at dealing with the impact of what does the deficit actually itself do to growth. And I've sort of famously been deficit were not a problem during the period of a depressed economy. Now that we're close to full employment, there may be some negative. But there's a subtler issue, which I don't think any of these organizations, even the Tax Policy Center, are great people, but I don't think they've gotten a complete handle on, which is growth in what exactly? Because what they find is that gross domestic product, which is what we usually talk about, it will be bigger, but we're also going to, the way that happens is by increased inflows of foreign capital. That means that we have a bigger capital stock, which means that we produce more, but it also means that we pay more profits to foreign companies. So, also, actually about a third, we think, of the corporate tax cut benefit to corporate after-tax profits will actually go to foreigners. So if we ask what happens to gross national income, the actual income of U.S. residents, it's not at all clear that goes up at all.
Oh, so that's interesting. So usually, people talk about GDP, which is gross domestic product, which is total activity economic activity within the United States. Yeah. You're saying that the gross national product number, which is the total economic activity that accrues to people in the United States, so including U.S. profits from foreign activities, but excluding profits to foreign owners from U.S. activities. You're saying that could be negative even if GDP was positive?
Yeah, it's never been an important issue in the United States until now, because the difference between GDP and GNP is trivial. Mm-hmm. But economies that are smaller, that have lots of foreign investment, can be a really big deal. Ireland, GNP is only 75% of GDP. because there's so much foreign ownership. Now, and we're, this bill, even if it does what it's supposed to, it kind of moves us towards being more like Ireland, which means that we could see a headline GDP number that is up some, but that's all or almost all offset by these increased payments to foreigners.
So one of the key arguments that Republicans have been making for this bill is that when you cut corporate taxes, you get big benefits to workers, not just through economic growth, but because they contend that a substantial fraction of the corporate tax is actually paid by workers, in effect, because companies that prefer to locate in places with lower corporate tax rates, they'll be willing to pay higher wages when they're operating in a place that has a lower corporate tax rate. And even that Tax Policy Center analysis that we were discussing, a somewhat left of center organization, they assume that about 20% of the corporate tax is ultimately borne by wages. Is this right? Is there a significant benefit to workers from a reduction of the corporate tax?
Probably some, a little bit. I mean, and it matters a lot what horizon we're talking about. In the short run, nothing. All of this effect only works through capital coming in and building up and increasing the demand for labor. So that takes time. So if you ask what happens in the first year from a corporate tax cut, none of it goes to workers. Over the course of 10 years, maybe a larger portion, but there are limits on how far this goes. So yeah, there's something there. Realistically, we have to imagine there'll be some effect, but will it be visible? Will workers see their wages increase in a way that anyone will notice over the next 5 years? No.
So if the effects are small, does that mean that sort of some of the doom and gloom about this bill from Democrats has been excessive? I mean, let's say it's going to add a few percentage points to public debt as a percentage of the economy 10 years from now. Interest rates are very low. It doesn't look to me like that there are likely to be significant crowd out effects from that. Are there significant downside risks from this bill? Is this going to hurt us, or does it just not matter very much?
I think it probably doesn't matter very much. I mean, it's if you actually, it's not a good thing. You're supposed to use times when you're near full employment to pay down debt, not run up additional debt. And running up additional debt, with most of it going to a very small number of people, is a particularly bad idea. But if you ask, is there a crisis? It seems unlikely. It just, politically, I would love to say this is going to be a disaster, but I actually, when I try to work through it, I've written about this a little bit, I can't convince myself that there's going to be much of a market reaction at all.
Huh. So you don't describe the run-up in stocks to this bill? Oh,
actually, no. Look, stocks are up around the world. They're up by about the same amount all around the world. You really can't tell. If you didn't know that the U.S. numbers were the U.S. numbers and the European numbers were the European numbers and the Japanese, you wouldn't know which was which. So there's a global stock boom, which is not particular to Trump. If you think there's a Trump bump, then you have to say there's a Merkel bump and there's an Abe bump as well.
Right. How would you characterize economic performance right now? Is the economy good, and how much credit does President Trump deserve for how the economy is doing?
The economy's pretty good. In fact, it looks like we're close to full employment, although we don't know why wages aren't rising more. I think Trump gets essentially zero. Even under, first of all, there have been no actual policies, right? There hasn't really been any policy change, and the convention usually when people try to assess the economic impact of administrations is to assume that the first year reflects the policies of the previous administration. So, no, there's nothing that is Trumpian about what's going on.
Is there any possibility of sort of a self-fulfilling prophecy of economic improvement under Trump, which is to say, immediately after he was elected, there was a big improvement in consumer sentiment, all from Republicans, who thought that the economy was terrible, and then it turned around, and because Trump was going to be president, they thought things would be really good. Could that be manifesting as more consumption, more business investment? Just because people feel confident in Trump's performance, that could be something that itself causes the economy to improve?
Well, the thing is, the economy's been adding jobs at a steady rate for years now. Mm-hmm. You can't see, if anything, the rate of increase is leveling off. The curve is bending downwards. You can't see any Trump effect in there. And look, these issues of self-fulfilling confidence or loss of confidence, that's a big deal when the unemployment is 10%. Mm-hmm. Then the economy's performance is crucially dependent upon having enough spending out there. Where we are now, consumers get a lot more confident, the economy starts to grow faster, the Fed will raise rates faster. So it's kind of, we're not in that kind of universe anymore. That's a 2010 story, not a 2017 story.
Let's talk a little bit about the Fed. You've expressed concern, am I correct in saying that you think Jay Powell is a good pick to run the Fed?
Yeah.
But you're concerned about some of the other choices that the president has made or might make about the Federal Reserve Board?
Yeah, if you looked at, I would have said there was no good reason not to keep Janet Yellen, but Jay Powell appears to be a reasonable guy. Appears to be no significant policy error between him and the Yellen regime, which is fine. What I was afraid of was that, given that Republicans have been insistently and defiantly wrong about everything monetary for the past 10 years, that they would make the having been wrong about everything be the criterion for being the chairman of the Fed. Well, that didn't happen. So Trump picked Powell, who looks like has been okay. The first up on but the people who are now being floated for Fed board do seem to fit that criterion. So we have Marvin Goodfriend, who's a reputable monetary economist with a tremendous track record of saying inflation is coming, we must get ready to start raising rates now during 10 years of a depressed economy.
How much should we think of Fed policy as being driven by the on-the-record ideological statements of people who end up on the board? I mean, it seems like, first of all, the chairman ends up having a lot of influence, even though decisions are made by a vote of the board. And then also, it feels like there's a lot of reaction to political and economic events. Once you get on the board, it becomes a lot costlier to be wrong about monetary policy than when you're someone just observing the board.
That has historically been the case. It has historically been the case that the staff ends up, the staff plus the chairman ends up setting monetary policy, and that members of the board rarely will balk the will of the chairman on if it agrees with what the staff is saying. You can see that in both directions, by the way. Ben Bernanke was a much more aggressive monetary dove before he went to the Fed than he was afterwards. During the crisis, we kept on saying, if only Ben Bernanke would listen to Ben Bernanke. But once you get at the Fed, there's an environment, there's an acculturation. But this is Trump's America, so maybe the old rules don't apply anymore.
But Trump says he's a low interest rate guy.
Sometimes, he's been all over the place on that. But the question is, to what extent are the Paul Ryan is an Ayn Rand monetary theorist who thinks that Atlas Shrugged contains the rules for monetary policy. So how much is we don't know what's going to happen.
Let's talk about trade. Do you worry at all about Trump's rhetoric on trade? What if he follows through on threats to withdraw from NAFTA or to start a trade war with China? What's the effect of that in the U.S.?
The NAFTA issue, I think, is it's a huge issue if it happens, which is probably why it probably won't happen. But the thing about NAFTA is not so much who are the beneficiaries. I think in fact the United States benefits from NAFTA, but the main point there is that there's no such thing now as Mexican manufacturing and U.S. manufacturing. There's North American manufacturing. It's this tightly integrated complex of industries where stuff is shipped back and forth. Different pieces of an automobile are made all over the continent. And if you break that up, if you disrupt it, then that's hugely, then we're talking about a lot of disruption at the industry level. We're talking about a lot of plants closing, maybe new plants opening, workers, it would be exactly the same sort of thing that people complained about from the growth of trade, except this time, it's like the old
one-time disruption would be substantial.
It's like the old joke about the motorist who runs over a pedestrian and says, "Oh, I'm sorry, let me fix it." So he backs up and he runs over the pedestrian again. And so that would be a hugely costly thing if we really disrupt NAFTA. That means that industry is horrified at the prospect. And now, so in a way, trade is going to be the test of whether there's any of that Trumpian unorthodoxy left. Is he willing to balk the big companies on that?
Regardless of whether there's a good remedy available to Trump or whether the remedy that he's talking about makes any sense, is he right in his critique that free trade and relatively loose immigration policies have depressed the wages of native-born American workers over the last few decades?
Trade, a little bit. Most estimates do suggest that, a reasonable estimate suggests that if increased international trade did have some depressing effect on blue-collar wages in the United States. We import labor-intensive products. That reduces the demand. It's probably not huge, and it's probably mostly in the past. It's not a continuing force of further downward pressure. Immigration, actually, the evidence suggests that immigrant workers are not, for the most part, competing with native-born workers. They're competing with immigrant workers who are already here more than that. Even though, you take somebody with 11 years of education from Mexico or Central America, compare them with somebody with 11 years of education born here, they're actually very different. The skill set's very different. The occupations are very different. So the immigration thing, although it's the one that resonated most with Trump voters, is probably, in fact, the place where his economics is just wrong. He has a better case on trade.
Recently, I spoke to Fidelity Large Cap Stock Fund portfolio manager Matt Fruhan. Here's what he has to say about opportunities in equities. So to start off, what's your outlook and how are you positioned when you think about value versus growth?
Sure. I think in the last couple of years, my funds have tilted a little more value. I try to manage them in kind of a large cap core box, but the opportunities I've seen over the last couple of years have been tilted more to the value side. And so when I look 3 to 5 years out, I try to look at combination of both earnings growth and yield as well as the multiples that I'm paying for stocks. And right now I think we've been in a market environment where the value parts of the market have not seen the same multiple expansion as the more growth-oriented parts of the market. The growth area has been phenomenal for the last 10 years really, but really picked up in the last three or four. Tech has been a huge driver of that, and these are phenomenal companies, a lot of them. They're generating a lot of earnings growth with great cash flow, some of these companies. But I think when you look at the market construct and environment that we're in right now, quantitative easing has led to an abundance of capital in the market at a capital cost that's very low. And so a lot of these companies are taking advantage of that, which is intelligent and smart, to really drive earnings growth. But it's also leading to valuation expansions that I think are getting to the point where there's probably not much more left to run on that piece of the actual total shareholder return.
And you mentioned the tech stocks, which are trading at very stretched multiples. Can you talk a little bit about how you feel about the drivers of the tech rally recently, the FANG stocks?
These are companies that the consumer loves, and a lot of them are generating very fast revenue growth. Pieces of the FANG stocks are very profitable, generating lots of free cash flow right now. The question on those companies is not really, are these going to be profitable models in the future? It's going to be how profitable are they going to be, and how long can they sustain the actual growth trajectories? What type of multiple are you going to put on these companies if maybe growth is going to slow over the next 3 to 5 years?
And can we talk a little bit about like the Facebook and Google, which are in one group there? And you mentioned that right now they have 30% of the...
So those two companies have done a fabulous job penetrating the online advertising market. They're about, call it, online advertising is, call it, 35% of global advertising, coming from almost 10 years ago. So they've taken a lot of share in this market. I think a lot of advertisers are going where eyeballs are, and you've seen these companies do a great job finding new users and being able to monetize the user base. The question now is, if you look at kind of what the consensus or first call estimates are for the revenue growth of some of these companies 3 to 5 years out in the future, the online advertising space to hit these estimates needs to basically move to almost half, if not more, of the overall global advertising market. And I just think it's going to be a harder ask for these companies to generate that type of growth at this size than they have been able to do the last 10 years.
And on the other side, the Amazon and the Netflix, what would it take for them to sustain these multiples?
That's a great question. I think quantitative easing is a big part of it, and the low rate environment and the cost of capital environment has been very helpful to companies where the operating models are not yet proven. I think we have to look out 5 to 10 years before we really see the type of free cash flow margins and operating margins that these companies are going to be able to generate. I think at that point in time, there'll be something for traditional value investors or large parts of the market to actually sink their teeth into and try to value these companies. I think we either have to see growth slow or a different cost of capital environment. Until then, I'm not really sure what's going to make these companies and the market change the way that they value them.
That's it for this week. Thanks so much for joining us. Thanks to NASDAQ MarketSite for hosting us here in Times Square. And thanks, as always, to Fidelity Investments for sponsoring the show.
We'll see you next week.